Real-time daily trading ideas. Welcome, good morning. It's Monday, 23rd of October. This is Berlin speaking, Jens from Admiral Markets Berlin office. I will just do the introduction and then a couple of minutes or seconds later, Jay Medrow will overtake and will present his trading idea of the day. 5 days a week, 5 different traders. We will speak about trading ideas, strategies, market screening, and of course, always answering a couple of your questions live in this quick and smart webinar. Let's have a start. Welcome to our webinar. Before we start, of course, always a small risk disclaimer. Forex and CFDs are leveraged products and can result in losses that exceed your deposits. Please, before you start with real trading, start with a demo account, make yourself familiar, and after a while, if you feel great, then you can start with live trading. If you want to see the full risk disclaimer, just visit one of our web pages, for example, Admiral Markets Global or admiralmarkets.com, and you will find a full risk disclaimer about all the potential risks. This is me, but I'm not the main person. My English made in Germany, but hopefully a couple of quality too. But the main speaker today is Jay. This is our scheme. Today's actions are tomorrow results. 5 days, 5 different traders with 5 different trading styles. Monday is Jay's day, Tuesday it's Paul's day, Wednesday it's Mike's day, Thursday it's Nenad's day, and Friday it's Dirk's day. If your time allows it, just join us every day. And if you have just a couple of days time, just visit our YouTube channel and you will see live the live recorded webinar a couple of hours later in the YouTube channel. So today it's Jay's day. It's a premiere, first time. Let's have a start. Hi, good morning, Jay. Now it's your turn. Let's switch to your screen.
Good morning to you, Jens. Good morning, traders. Let me just set it up real quick that you guys can see the correct screen. And I don't waste your time. Here we go. This should be you should be seeing a blue screen right now.
Yes.
And now you're seeing my picture, right?
Yeah. Yeah.
So excuse my voice. I spent 10 days in Asia. I just got back last night in the middle of the night. I was up 17 hours. And then I started preparing for a quick morning brief. I was out with some traders. We worked very hard. And at the end of the 10 days, we allowed ourselves to have a little bit of a celebration. So as my motto goes, trade smart, live free. Here you go. That was all part of living the free part. Yeah, we put in a lot of hard work, but then it's good to blow off some steam as well. So welcome. As you can see here, my focus is mainly on institutional trading and investment process. I spent many years on the institutional side. I was with several of the big boys, and I was one of the big boys actually moving billions. So I started an operation last year. That's how Jens and I met. I'm a German-speaking educator. My intention is to increase the level of retail awareness and education significantly in the German market. So I trade as I've always traded, like an institutional trader. And what you will see, and over the time that we get to spend together over the next few weeks, is hopefully you'll see that it is fundamental data and sentiment that moves the markets, that causes the large portfolio manager at XYZ fund to call his execution desk, which in turn calls us, the banks, which then ends in a transaction. Has nothing to do with a chart picture, but of course, in the charts, we can see at times the positioning of the big boys. So just give it some time. And if you have questions, I'm sure you can ask via Jens, and we'll try to answer your questions in time as well. So let's see, how can we get started? This is a typical format for a morning brief on Monday morning when you hit the desk. And it always starts with good morning, traders. What happened overnight and what do we have ahead for this week? So let's play along. Hopefully you guys had it on the radar. Japan elections, Abe's party, 2/3 supermajority. There was an expectation in the market that he may not make that. He made it. 2/3, that actually means that he can now change the constitution. There is one aspect that he wanted to change. The market expects the so-called Abenomics, i.e. the money of ultra loose monetary policy to continue, which of course resulted in an immediate weakening of the yen, and that is expected to go on. Now, the Japanese economy is an export economy, and a weak yen actually meant that the Nikkei hit another all-time high, plus 1.1% at 21,696. Hopefully you're all long equities. If you're not, you got to get in the game. Equities look extremely strong. This was a catalyst, and there's some funds that need to wait for the outcome of this landslide victory Now that it's certain, there's a lot of money that's actually going to move into Japanese equities on top of it, okay? So buy pullbacks on that one. Next point, US Senate passed the 2018 budget, and it passed marginally with 51-49, but it's important for us to know that this paves the way for Trump's tax reform. As we all know, so far, Trump hasn't gotten anything done, nothing. It was horrific. After his election in November, the markets went crazy on what's called a risk-on tone, and then we all expected the so-called reflationary trade to hit. It didn't. The markets came off. There was a lot of dollar weakness. A lot of guys were positioned on the wrong side. Institutional money was long the US dollar, but Trump and the Fed actually we're all still, all Western economies in a currency war, who can depreciate the fastest and the hardest, so that we actually saw a dollar weakness. Now, this budget pass actually means that Trump may get somewhere for the first time with his tax reform. If that tax reform hits, you better be already long US equities, okay? This is a major, major deal. We're talking $3 to $4 trillion getting repatriated in the next 4 years. This is worth massive points in the index. But we're also seeing the currency react, the DXY, which is a trade-weighted basket versus 6 other currencies, heavily weighted towards the euro with slightly over 50%, but still it's a good indication of what the dollar is doing, is attempting to break 94, the figure. So that was a line in the sand that we broke below the 95, and now we're on the way back up. But also note that Trump said, and that this week we would hear who is going to be Janet Yellen's successor, because there's a change at the helm of the Fed, and that's also important because whoever gets that job will have an implication in the monetary policy of the Fed. So please note that Gentleman Powell or Ms. Yellen are doves, and if they would be put into the seat, we would expect a mild pullback in yields. And please note that, of course, currencies always follow yields, especially on the short end of the yield curve. So if Taylor or Warsh would be getting the nomination, that would be interpreted by the market as more hawkish, and a slight rise in yields would be expected. Currently, for the December Fed meeting, the market is pricing in a rate hike probability of 91.7%. That's quite important. So let me just check my notes. Remember, Powell dovish, Taylor hawkish. Why is that? Powell currently #1 in terms of expectation who gets the job. It's because they have very differing monetary policy. Powell stands for a gradual and discretionary normalization, while Taylor is very rules-based. Remember, all of these guys are professors, most of them at least are, and gals like Janet is. And rules-based would means that the nomination of Powell is, like I said, dollar negative, and the nomination of Taylor would be dollar positive. This is important to have on your radar. Trump is leaning towards Powell, and here it gets political. It's also important for you to know that. He wants to get somewhere with his tax reform. The Senate paved the way, like we just alluded to. Congress does not want a hawk for the Fed seat. Congress wants a dove. And so this would be a perfect scenario where Trump just agrees to Powell and give in to Congress in hopes to get his tax reform done. So my personal expectation is Powell's going to get the seat. Powell's also backed by ex-Goldman, current U.S. Treasury Secretary Mnuchin. And that is the final note that's important here is that Powell also is in favor of rolling back financial regulation. So if Powell gets the seat, you want to be long Goldman Sachs, JP Morgan, you want to be long US financial institutions, the big ones, okay? You could also look into option plays on that one, for example, or for us over here in Europe on the CFD side, excellent via our broker to trade that. All right, carrying on, I'm already 9 minutes into it, I apologize. We saw the dollar yen react to it. It's already a 3-month high. It spiked through 114, and I'm looking to buy a pullback on that one. We can do the chart work together after I'm done with the qualitative part of this presentation. Tuesday, we have US flash PMI and NMI, and it's expected to tick up. If you've never been a student of PMI and NMIs, listen to me carefully, ladies and gentlemen. You better start learning about this severely. This is a leading economic indicator, and we focus tremendously on it. But in this sense, in the September one, on the qualitative part, it was mentioned that the focus for this time will be on business expectation activity level. Yes, that's what it's called, business expectation activity level, because that's leading to the PMI and NMI itself. On Tuesday, we have the same thing in Europe. We have what's called the European Economic Sentiment Indicator. And here, manufacturing and services is expected to slow a tiny little bit, but make no mistake, EU economy is growing at the fastest rate in over 6 years. This growth is broad-based. We see an improvement in corporate profits. We're seeing an improvement on demand and on the labor market side as well. So where are we in terms of the economic business cycle? Europe is out of the trough. We are hitting our expansionary phase, whereas the US are in late cycle stage. Okay, and this is important to note, and you see that in terms of global flows of money as well. You see a lot of the institutional money already went into European equities, and a lot of the institutional money in the US went out of US equities, but we have an increase in US corporate buybacks of their own shares, and we have an all-time increase and an all-time high, as reported by Charles Schwab, #1 retail broker in the US during their last earnings call. If you haven't looked at it, listen to it. It's all online. Quite interesting. All-time highs since the global financial crisis that the retail trader are opening up retail accounts. Let me tell you one thing, the retail trader is never right, never. So US, we're late stage, but for the next couple of quarters, I expect very, very good growth. If the tax reform hits, there's no other way around. We got to be long US risk. Okay, Wednesday. Let me come back to the European Central Bank real quick. No, that's coming later. Let me see. Yeah, it's coming later. We got to talk about the European Central Bank real quick. So on Wednesday, we have Aussie dollar CPI coming in. It's expected to come in better than last time with 0.8 versus 0.2. Year-on-year headline is 2%. Please note that there's a high seasonality in September to CPI. And after the June price setting is done on administered prices and energy costs could be leading prices higher, we can expect that is the explanation for this uptick, 0.8 versus 0.2. Then there's something that the RBA looks at that's called 2-quarter annualized pace of core inflation forecast. And that's expected to decelerate to 1.7 from 2.1. And that is well below the RBA's target band. We also had a downtick in CPI in New Zealand, and between the two economies, there's a high correlation of around about 60%. So since the New Zealand CPI already ticked down, we are now focusing on what is the inflation doing in Australia. We had a rise in the Aussie dollar, and the fundamental catalyst for that was not an improvement significantly in the economy, but it was more due to a weak US dollar. So you need to understand why is your market moving. And in this case, the Aussie went up on the weakening of the dollar and not on a strength in the economy. But a rise in Aussie dollar means we have that's weighing on domestic inflation. And the RBA warned us that further slowdown in domestic growth and inflation could happen the more the Aussie dollar rises. So that tells us that they don't want the Aussie to continue to rise more and more and more. What's good for Australian economy is that it has currently a very low unemployment, and that is expected to feed through to positive consumer behavior, i.e. Mr. and Mrs. Smith have more money to spend. That's good. But the market could shift now in its rate hike expectations from the second half of next year and bring that rate hike expectation forward to the first half of next year. If that happens, we are already there that large institutions are going to look for positioning their books long Aussie dollar versus short Japanese yen. Remember, headline #1 this morning versus this, you can look to long the Aussie dollar versus yen. Next point on the agenda is, if my thing would work here. Okay, Wednesday GDP for UK. What is it doing? Come on, is expected to be in line. We have a rate hike expectation and a market prices in a 60% probability that the Bank of England is going to hike during the November meeting. This, ladies and gentlemen, is already above 80%. But the economic numbers came in so mixed that it went down a little bit to 60%. On top of that, all this discussion about Brexit, no deal, yes deal, no deal. This also meant that the volatility of the British pound in the futures market increased Friday night late and went to 9.06. It's good. That means you got to watch your ATR values when you day trade. You always have to have an eye on implied volatilities, and the options market and the futures market can give this to you. This is CME. You go to the CME site and you can look this up. So the pound, interestingly enough, has shown some strength versus the other G7 currencies of the past week. So I took the opportunity to take a look at the COT positioning over the weekend, and that's mixed. So what does that mean? It actually means for the pound, we now need new fundamental catalysts so that the portfolio manager at XYZ fund picks up the phone to trade, right? Cable is lingering around 132 currently until we get new information, nothing to do in the pound. So I've always encountered retail traders, they look at one or two charts and someone told them you got to become an expert at trading cable. That is bollocks. You don't have to become an expert at trading cable. You got to become an expert on what is driving a market and then be in the market that is actually a reason to move right now. Okay, just because Eurodollar is the most liquid market doesn't mean you have to trade Eurodollar. If Eurodollar is not moving, there's nothing to do. On the other hand, Aussie New Zealand has a reason to move higher or lower, then you want to be in the Aussie New Zealand chart. That is what I'm trying to say. Okay, on Wednesday, we have the Bank of Canada policy statement. The focus here will be on financial conditions. The Bank of Canada, you may know, hiked 2 hikes. The last 2 meetings, they hiked each 25 basis points. So they took out all of that softening that they did, all of that dovishness that they did, the moves that they did in 2015. And now they need to give themselves a little bit of time to see how the economy reacts to that. Yeah. So the market currently expects no hike. Again, positioning in the COT report, the Canadian dollar, the dealers are significantly short. That's important. So I would be very careful in longing the Canadian dollar right now. The bank is, as I said, data dependent and has a slightly hawkish bias. They are now focusing on what's called the output gap, and they're guiding for moderate growth in H2 17. So they already guided down for moderate growth. Again, currently nothing to do. If you want to play the Canadian dollar, then rather focus from the short side currently. Thursday, we have New Zealand September trade data. The deficit expected to narrow. September is seasonally a soft month for exports, while imports are expected to be strong because the energy prices surged. And in this report, we'll also get guidance on how the RBNZ sees Q3 trade estimates. So the expectations here are for the current account deficit to remain at around minus 2.8% of GDP. Okay, current account is a very, 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 very important fundamental piece of information that professionals look at. For example, the euro is a current account positive currency. That means underlying there is strength for the euro. And SocGen, my last shop, actually came out with a research piece late end of last week, where they said that due to the current account surplus, the euro dollar, based on what's called the PPP economic model, is expected versus the dollar. So the euro dollar rate is expected to still have upside potential of 7 to 10% from here. And it's still 9% below the average of where euro dollar traded in the last 10 years. So current account positive, you have headwinds for the currency. Current account negative, and New Zealand dollar is negative. Sorry. Current account positive is positive for the currency. I said headwinds, that was wrong. And current account negative always means fundamentally negative headwinds. It's negative for a currency in question. Thursday, finally, ECB policy statement. There's a taper expectation that they're going to reduce what they're buying in their bond purchasing program. They're currently going to buy until the end of this year, 60 billion euros out of thin air every month. Okay. One massive point that I always bring up here is how come that Italy can refinance itself cheaper than the United States of America, which is the #1 economy in the world. And the reason why they can refinance cheaper is because Mario Draghi and the ECB are buying up Italian sovereign debt, sovereign treasuries, okay? So it's quite important. Basically, this means tapering means that they're going to come off the gas when it comes to monetary policy, expansive monetary policy. But how much and for how much longer are they going to do that? Draghi made absolutely clear that the euro still needs support from his side, i.e. the central bank. So currently the market expects 25 to 40 billion per month of purchases for the next 9 months, starting in January 18. So an extension of the program until September 18, but not 60 billion anymore, but 25 to 40. Let me repeat one thing. There's no economic growth that backs this number. If you buy 60 billion or 40 billion or 25 billion, these are all euros created out of thin air, right? So the statement is very important. There's a very, very good investment bank. They actually say that where they expect the bank to head to is 20 billion per month, but until the end of 2018. Now, another thing that you always want to look at is where is the largest outstanding volume and open interest for options. And if you look at the euro-dollar market, you'll see that there's a lot of options from 118 to 118.55, okay, 118.50. So on the downside, we see a lot of options at 117.20, 117.30. So what I want to do is, the COT dealers, by the way, are short. The dealers are short. So I expect that the dealers are going to push it up to 118.50 area, then let it drop down to 117 area. And this is the trade that I want to do ahead of Thursday, okay? Because overall, I think that the euro may head higher, even though what we currently have is a picture where the dollar is expected to strengthen also into the Fed announcement meeting, and into the next policy meeting. But for this week, I would like to see the big boys move into short positions, 118.50 down to 117.20. That's trade number 2. Okay, then there was a market talk that this entire program may be capped at 2.25 trillion, and that would imply that we have 220 billion more that Mario could purchase until December 2018. Sorry, this is a typo. There was another thing where he himself said forward guidance on rates is very, very important. And he's talking about here the sequencing. When are we going to hike rates? And we're talking 2019 here. So what you need to remember is that the market's always trading 6 to 18 months the future, right? And this whole tapering is not going to have major impact. So whatever they say on Thursday is not going to be a massively moving event for the market. But the first time you'll hear something about sequencing and when exactly, really for sure, they're looking to hike, that's going to move the euro tremendously. Then on Friday, we have advanced GDP expected to be at 2.7%. And it's important, nothing really of importance. The only thing here is that a pickup in inventory accumulation could add 0.9 percentage points to the GDP growth. And one component of this GDP number is what's called the PCE price index. And the Fed loves this as an inflation indicator. This is what they focus on, PCE price index. It's expected at 1.8% versus last time 1%, still way below the 2%. The other indicator that the Fed looks at is the five-year forward inflation expectation swap. And then on Friday, we have University of Michigan Consumer Sentiment Index, which is also a leading economic indicator. Very, very, very important. So where does it leave us? We talked about the ECB. We talked about the Fed. Let me just double check that I have everything here that was important for you guys for this week. We talked about the Bank of Canada. That's expected to stay pat. We talked about the RBA and the RBNZ. Okay, so let's get over to the charts to finish up for today. What's really important is that we, like the big boys, utilize fundamental and sentiment drivers to be involved in a currency pair that's going to move. So if I ask you, Japan, ABI just won, dollar, we're expecting an increase, we're expecting some strength in the dollar, so that naturally means long or short dollar yen. If I can ask you a question, long or short dollar yen? Mohammed, for example, Shipur, Eric, you guys asleep? Was I talking too long? Too long. You guys are there. Excellent. Exactly. We want to look at long. Okay. So let's work through the charts together. Let's start at a chart picture. Important to us is just whatever the chart depicts and volume on the bottom. And let's just be real simple. These are fractals. They're called fractals. And when you have a reversal like this, is called a close and reverse. So somebody on the weekly chart was able to hold this level and reverse. So from the point where we are currently, I just look for the last swing high above me and the last swing low below me. It's super simple. No pro looks hours and hours at a chart, completely irrelevant. Obviously, we've been trading in a box here on the weekly, right? So if an exchange rate would move too far up or down, the central bank would intervene. And we see this with the Swiss National Central, SNB, Swiss National Bank they do that frequently. We see that with the Bank of Japan doing that frequently. But we also just listened to the Reserve Bank of Australia clearly stating, buddies, if the Aussie dollar goes to increase higher and higher, we need to do something. The other aspect that any central bank is really worried about is inflation being too high or too low, i.e. deflation. In the case of the Bank of England, in the last statement, they said, our models, we are surprised by how high inflation is due to the weakening of the pound. It's above 3%, way higher than our own models predicted. And that means to us that we need to probably raise. And hence, the market expectations for February of 2018 were brought forward to November of 17 of this year for a rate hike for the Bank of England. And like I said, currently at 60%. So you just follow these expectations, which are given by the short-term futures market. Okay, so weekly chart shows us we're at a relevant point right now. Interesting, but we have new fundamental drivers that let us expect higher markets. So that's why technical analysis fails so often if you have no understanding of fundamentals, okay? It doesn't matter that the market turned around here last time, because now, months later, we have a completely different picture. We have a 2/3 supermajority in Japan. The Nikkei is at all-time highs. The yen is going to continue to weaken. That's the expectation. Large fund managers are going to jump on the bandwagon. You look at the positioning in the COT report and you know, okay, I want to be long dollar yen. But where? So now you can adjust this a tiny little bit. And what I tend to do then, I didn't do this, I didn't prepare well, sorry, Jens. I draw a box above here. But we can do it like this now as well. It doesn't matter. So this was an extreme point, and we're on a daily chart. And this is interesting because last time we turned around here. And now I expect the market to adjust higher, accept higher prices, and from here then to move higher. One problem is we have what's called a square up. The market in the overnight session or on Friday ran away ahead of this Japanese weekend election. So we need to wait for a pullback. We can never, ever be impatient in trading, ever. Impatience is for retail traders. We can't do that, right? So we're waiting for a retracement or what's called a square up. Now, if the fundamental reasons are so strong that there's no retracement, then you got to jump on the bandwagon. And I tell you, for me personally, your trading style needs to suit your personality, right? I'm so conservative, I hate buying breakouts. Breakout buying is for suckers. And what I teach during my seminars and my one-year mentoring programs is how you can actually read the order flow from the different market participants. So we go down to the 4-hour chart and we see that we had a breakaway gap and it's almost filled, and we're already at daily R1 and there's an ADR low and there's a daily pivot. Okay, that's great. So the daily pivot added what we call a role reversal. Last time there was something here. So this entire area is interesting. It's really interesting. What time is it? 11:27. So London already bought the market up. Like I said, we're accepting higher prices. And on the 4-hour chart, we have a daily pivot here. So this is what we can do. We can go ahead and take, for example, this last move. And we take a look at, this is Fibonacci. You're all familiar with that, I'm sure. Every retail trader is super familiar with this. And we go down to a 1-hour chart. And let's see what the 1-hour chart tells us. This is, by the way, market profile here, right? So the level to enter, was at the point of control, 113.75, which is also an options number. So that's brilliant. But that opportunity is currently gone. But maybe New York will give it to us later. So this is what we'll do. Let's see. We're going to enter here, 113.75. And let me just adjust this trend line. This is in German. Isn't this funny to you guys? I don't want it to extend. And I would like to have it a little bit thicker so you guys can see it a little bit better. And let's make it, I don't know, blue, for example, okay? So I want the market to come down to this level. And then if you were to do a swing trade, sorry for that, I meant to touch this guy, then target number 1 would be the 127 extension, and target number 2 would be the 1618. But this thing has really the potential to move higher. But you see that the ADR is above here. You see that we haven't been here in a while, okay? So even if we go to the weekly chart, the next level that could be of interest is 118. So there may be some liquidity that we hit above these swing points from investors that have a larger time frame. And the question is, will this liquidity be used by the big boys to pull the market down, because all the large funds now want to be long? Okay, and you as a market maker, you get these calls. Fund A wants to be long, Fund B, Fund C. So you're selling them dollars, in return you get yen. And me as a trader at a bank, I'm losing an asset, i.e. dollars, that expected to go up in value, and I'm receiving an asset that is expected to drop in value. Now, if I don't go against that, how long do you think I'm going to keep my job? Probably not very long, correct? So I need to somehow withdraw liquidity from the market, so the market drops lower, so that then I can go ahead and add to my long position, so that I then can call my salespeople and say, hey, Stephen, call XYZ fund and tell them that I now have a very good position for them, offer side dollar yen. Do you understand that, guys? You got to get off your retail glasses, forget about retail trading. Everybody and their grandmother in the big boy world needs to be longer dollar yen right now. Okay, so it's not going to happen that the dealers can just offer continuously dollar yen, because they need to have dollar yen themselves, and that is a problem. So wait for the pullback, and on the daily chart for those guys who are swing traders, wait for the role reversal, wait for 113.50, for example, as an entry. And for the guys who are swing trading, I would definitely like to see 113.75 as my entry, and then target 1 and target 2. If you're completely impatient, then go ahead and buy right now, for example, but be smart about it and go ahead and risk no more than 1% of your account, for example. And this is great about Forex trading, because you can cut your positions and take that 1%, whatever your position size calculator says that is in terms of mini or micro lots, and divide that by 3. And put on 1/3 of the position here, put on 1/3 of the position around yesterday's low, which is, let me see, where's yesterday's low? Here, yesterday's low. There's always some liquidity expected to be below yesterday's low. So what would be great is, for example, if we go anywhere into this box here and there's a big POC, then this kind of trade. But again, the fundamental reasons are too strong. I don't expect the market to pull down like that. That could only happen if we have a risk-off event, like North Korea threatening a war, or actually doing, actually pressing the button or whatever, and then global money goes into the yen and the dollar would be hit. I don't expect that at all. So the lesson here is go on with 1/3, for example, right now. Look for pockets of liquidity. Maybe the daily pivot, and then this trade, and then add to your position. For example, when you hit target number 2, double your position, move your stop loss up. You'll have a new average price long. Double your position here with target 161.8. I did half an hour. I'm probably completely in trouble with yens. It was my first time. I spoke a lot, very long, lots of fundamental things. Tell you what, guys, you write yens, have Jay slow down, or tell Jay to explain a little bit more this or that, and I'll adapt my style. I'm talking to you guys like you've been with me at the bank for 25 years, which obviously you haven't. But you got a first glimpse of what we look at in the bank, and it's completely different from anything that most of you have done so far, and that is what I'm trying to help you guys with. So talk to Jens, talk to myself. I'm here for you, and let's try to make you profitable and some money this year, and let's try to raise your level of quality in terms of your education, so that you can actually stop losing money on a continuous basis and start looking at the market more from an institutional type perspective. Okay?
We are really happy. Thanks for today. If you like Jay's style, next Monday, new chance to get him live, or if you like to watch the YouTube video a couple of hours later today, you will find in our YouTube channel. And if you don't like him so much, tomorrow is another day. Tomorrow it's Paul's Day. Like I said to my introduction, 5 days a week, 5 different traders, 5 different styles. And tomorrow it's another day with another style. If you like to trade Forex and CFDs, there are many reasons why to choose Admiral Markets. Here you will find some of them, for example, best index offer or best order size, even CFD mini contracts are available, or your choosable leverage. If you want to trade today with 500 leverage and tomorrow maybe with just 50, it's your choice. And of course, you can trade with MT4 and MT5, and all information about that you will find always at admiralmarkets.com. Yeah, thanks for now. And here you will see again the youtube.com/admiralmarkets link. A couple of hours later today, you will find the video recorded there. Thanks for now, and tomorrow see you again with Paul. Thanks, greetings from Berlin. Bye-bye.
Thank you guys. Bye-bye.